Hi all, welcome to Free Float. I am Sham and I have Kishan with me.
Hi, Sham.
So today we are going to discuss composite factors, or what
Multi-factors.
Kishan calls it multi-factor investing. So to give you a brief background, last week we discussed factor rotation, which is basically buying whichever factor worked best, previously. There were some, caveats associated with it. So one of the shortcomings of that model is figuring out what is the appropriate look back period, right? So if you look back only 1 month and buy whatever worked best the previous month, your gross returns are good, but it leads to a lot of churn in your portfolio. So it works in the US, doesn't work in India because of STT, which eats up most of your most of your profits there. Um, so, so is there a better way to do it? Um, so I think Kishan raised the idea of why not just buy all of them, right? Because sometimes value works, sometimes momentum works, sometimes quality works, sometimes low all works. So what would it look like if you just equal weighted the whole thing?
And also,
So
I think, yeah, and also I think the biggest thing here is the timing, right? So you don't know, prospectively what will work in the future. Just some indication of what's worked in the last 3 4 months. But markets are dynamic; they can change, in an instant. So that's the only reason why we thought multi-factor might be a better, or at least it's interesting enough for us to explore that.
Right. And what was shocking, at least for me, was the value factor. So you would think that value stocks will at least not draw down as much as momentum, but that has not been the case. So if you compare the alpha index with with the value index, when it drops like crazy, and when it has gone up, it has actually beaten the alpha index as well. So it was a bit counterintuitive for me, because I expected value to be stable, but it is nowhere close to being stable. So I think this kind of gives an idea as to why going the multi-factor way is probably a good idea. You don't know what will work, like Kishan said, and just by averaging things out, you do seem to get a smoother ride as well. Just compare the drawdowns, across different periods. So Nifty 50 has actually drawn down way deeper than what the composite, portfolio has done, what the multi-factor portfolio has done. And I think most of it is probably because of the low volatility factor being there. So low volatility has kind of cushioned most of the blows, looking at the history at least. So yeah, it looks promising, and I think we should sort of explore setting up portfolios that that do this, and probably in a way that reduces transaction costs as well. There should be a way in which this can be done, right? Um, so, so the other thing I'd like to point out in this is uh, these indices, right? I'm not exactly sure when they came out, but I think it's 2018, right? Like 2 years ago. So it came out 2 years ago, and I think the only ETF slash fund that was on it was the Quality 30. So there was a Quality 30 ETF, but there's next to zero
Nothing.
interest in that. But the other indices, it doesn't really have any real money on it. So there's no ETF or fund that is that is doing this.
Exactly.
So all this is kind of weirdly theoretical, if you ask me, because It came out in 2018, but they have backfilled the data to 2005, right? So obviously they're going to, do something that makes those indices look good,
Yeah.
right? So they may have done, a bit more data mining than would have been prudent, I feel. Um, so people, I mean, investors need to kind of take this with with a grain of salt. These sort of
Yes.
back tests, because first of all, you have this data mining bias, right? You need to kind of know that, since 2005, a lot of things have changed, and these guys have backfilled it. Second thing is, unless you actually put money into a strategy, you
Yeah.
don't really know. Uh, I mean,
I mean, how it will work.
yeah,
Yeah. I mean, actually, how, and also, wouldn't NSE share the research methodology?
they have shared the methodology, but my point is that methodology itself
Yeah,
is
can be biased.
biased,
Yeah.
right? So the algo is framed in such a way that it looks good in historically. So how do you know it'll
Do
continue?
well in the future. Yeah.
Yeah, do it in the future. So I mean, this is a problem with all back tests, but but when you're doing this sort of composite, I mean, multi-factor thing, you may
Yeah.
be multiplying the effects of these back test biases.
Right.
Uh, and I think the third problem is, with no real money attached to this, right?
Then there's no point. It's very theoretical.
Yeah, it's very theoretical. And the other problem is, when money does come flooding into these ETFs and indices, that itself distorts the picture. So I saw that, I think UTI has plans to launch a momentum index fund based on the momentum index of NSE. Um, so, so my thing is, if it gets popular, then people who front run it, because the methodology is so widely known, right, will probably have, better profits than than the actual momentum fund itself, because
Right.
they know that this momentum fund is going to be forced buyers of certain stocks because of the index rejig at the end of every month. So front running it, at the previous close in itself, will give you a fair amount of alpha.
Yeah, I get what you're saying, especially on this part. In like the thing is, right now it's very theoretical on at least the NSE side, but you do have a lot more research globally, and also from our own factor portfolios, right? Because I mean, all of us have run some back tests on some factors. Uh, do you have any insight on that? Like, because apart from just using NSE data, just using our own factors to combine portfolios.
Right. So my thing is, quality and momentum go hand in hand. So if you have a quality and
It's like
uh,
a quality universe, and then you have momentum on it.
no, just as a two separate parts within a
Okay.
portfolio. So that has kind of worked out
Yeah.
well. Um, and the second thing is, combining momentum and low volatility, right? That has also worked. So
Yeah.
you take a predominantly I mean, you take a momentum portfolio, and then you optimize it. Basically, you reweight the
Okay.
momentum components,
Okay.
in order to give you a low volatility portfolio. So that has also worked.
Okay.
So you end up with momentum stocks, but with a low beta. So when you have beta less than one, it also gives you the ability to hedge it, just short the
Okay.
Nifty. So you get that, spread locked in. So these sort of combinations have worked in the past. So it is promising, but yeah, and you asked me about, the US experience, right?
Yeah.
In the US, multi-factor has been a failure. So people have tried different things, and it has just resulted in it tracking the S&P 500. And some say, it's because S&P 500 itself is a
It's a
quality and
multi-factor.
momentum. Yeah, it's a quality and momentum portfolio. So it's very difficult to beat S&P 500. It's not like India's Nifty 50 or Nifty 500, which is basically market cap, and that's it.
Yeah.
uh, S&P 500 does have a strong committee, which is very opinionated as to what is allowed into the index.
Index. Yeah.
Yeah, so people call it passive indexing, but it is not entirely passive. It's those stocks are actively selected, by the committee. And the funny thing is Tesla. A lot of Tesla bulls were so confident that Tesla will get into S&P 500 because of its rocketing,
Yeah.
you know,
Valuation.
market cap. But the committee rejected it, saying, you guys have no free cash flow, so take a
Yeah.
hike. So they do look into the quality of cash flows and of the company before letting them in. And I feel that's why it's a very difficult index to beat. And these multi-factor portfolios have found it difficult to beat S&P 500. Even now, I think both momentum and low volatility have lagged S&P 500. Can you believe it? Both low volatility and momentum have lagged S&P 500. It is that kind of an index. So
That's hard.
yeah. So it's
Because I would think momentum at least would have periods of like outperformance, like significant outperformance, which would give it some edge over the S&P 500.
Yeah, so the problem with momentum has been that some of the like they do have a cap on the total weight that a stock can take in the index, and if all that S&P 500 is just the fangmans, right? Uh,
Yeah.
Facebook, Apple, the fangmans,
Yeah.
Nikes and Netflix and all that. So those things have sort of boosted S&P 500, and any index or ETF or a fund that has a cap
Yeah.
on the weights have lagged because they can't match it.
Yeah.
So it's an interesting dynamic. So over there, multi-factor has lagged. Growth has basically trumped everything after 2008. So it's very difficult to beat that dynamic. Um,
Yeah.
yeah. So I mean, this is the challenge with active management in general, right? So
Yeah.
uh,
Which is I mean, active management is making decisions, right? I mean, long term, um, decisions where you won't know the result for the long term. So it's very hard for you to adapt, quickly to make changes, and that's the biggest challenge of like active management.
Yeah, and then there's always this whataboutery that happens. So for example, we compare these active bets in this multi-factor portfolio of Nifty 50, right? One can easily make a claim that if you just put a trend following overlay on top of Nifty 50, that would be enough. It'll give you a lower cost version of all this. And since you're looking back in time anyways and doing a back test, so both are more or less the same, in terms of risks. So it's a challenge, but the only advice I would like to give for investors considering this is stick through it for the long term, right? So understand what you're getting into thoroughly before getting into it, so that you can stick with it for the next 10-15 years, because that's when the alpha kind of comes through, right? Otherwise, there's so much heartburn, in between, right? So you're like, why are we underallocated to, alpha when it is doing well, and why are we overallocated to value when it is crashing?
Yeah.
So all those questions, keeps bouncing about in your head.
Yeah, interesting. Interesting because I mean, all these factors are things right now. I think which will just get commoditized in the future, and then there'll absolutely be no edge at all.
Right. So the edge actually would be time horizon, I think. So, all these investment strategies have the ability to outperform your benchmark over a long period of time, but
It's
the
sticking to it.
yeah, sticking to it is a challenge because every year, you'll have some googly or the other. So,
I
you
get
need to kind of, you know, pad up. All right, everyone. So that's it from us. Hope to see you again next weekend. In the meantime, if you have any questions about factor investing or momentum or all-star portfolio, please get in touch with us. Thank you and see you next week.
it. Thank you.